Hello traders, welcome back to Professor Liquidity. Today we are breaking down one of the most important topics in price action trading, market structure. Because if you do not understand market structure, every candle will confuse you. Price breaks a small high and you think the market is bullish. Price breaks a small low and suddenly you think the market is bearish. You enter fast and the market says, "Thank you for the liquidity." Now here is the truth. Most traders do not lose because they cannot see the chart. They lose because they are reading the wrong structure. They call every small break a break of structure. They call every small shift a change of character. And that is exactly how they get trapped. So in this video, we are going to explain market structure properly. We will cover what a break of structure is, what is not a break of structure, what a change of character is, what makes it valid, what makes it invalid, major highs, major lows, minor structure, and real examples for both bullish and bearish scenarios. Before we start, do not forget to like this video, subscribe to Professor Liquidity, and turn on the bell. Because on this channel, we do not chase candles. We read the story behind the move. Now let's get technical. Market structure is the way price moves between highs and lows. It helps us understand three things: market sentiment, trend, and order flow. Market sentiment tells us the general condition of the market. Is the market bullish? Is the market bearish? Or is the market ranging with no clear direction? Trend tells us the direction price is moving. And order flow tells us who is controlling the market. Are buyers in control? Or are sellers in control? This is why market structure is so important. Before you think about buying or selling, you need to understand the bigger story. And the bigger story usually starts from the higher time frame. If you trade on the 15-minute chart, you should still look at the 1 hour or 4-hour chart. Why? Because the 15-minute chart can show a bearish pullback, while the higher time frame is still bullish. A beginner sees red candles and sells, but the higher time frame is still bullish. So that trader is selling into bullish order flow. The same thing happens in a downtrend. The lower time frame can show a bullish pullback, while the higher time frame is still bearish. A beginner sees green candles and buys, but the higher time frame is still bearish. So that trader is buying into bearish order flow. This is why we use market structure to identify the higher time frame sentiment first. We want to know the pressure of the market before we look for entries. Now let's define the basic structure. A bullish market structure happens when price creates higher highs and higher lows. Price pushes up, then price pulls back, then price pushes above the previous high. That new high is a higher high. The pullback low that stays above the previous low is a higher low. This tells us buyers are defending lows and pushing price higher. A bearish market structure happens when price creates lower lows and lower highs. Price pushes down, then price pulls back, then price breaks below the previous low. That new low is a lower low. The pullback high that stays below the previous high is a lower high. This tells us sellers are defending highs and pushing price lower. Now remember this clearly. One green candle does not make the market bullish. One red candle does not make the market bearish. A trend is not one candle. A trend is the sequence of highs and lows. If price keeps breaking highs and protecting lows, the structure is bullish. If price keeps breaking lows and protecting highs, the structure is bearish. That sequence is what shows order flow. Now let's talk about break of structure. A break of structure happens when price breaks an important structure point in the direction of the current trend. In a bullish market, a break of structure happens when price breaks above a previous major high. This shows buyers are still strong. It confirms bullish continuation. For example, price creates a high. Then price pulls back and creates a low. Then price pushes up and breaks above the previous high. That is a break of structure to the upside. But here is the important part. After price creates that break of structure, the low that caused the break becomes the major low. The major low is the low where buyers stepped in. It is the low that pushed price above the previous high. It is the low that protected the bullish trend. So in bullish structure, the major low is extremely important. As long as price stays above that major low, the bullish structure is still protected. Price can pull back. Price can create red candles. Price can even break small internal lows. But if the major low is still protected, the main bullish structure has not fully changed. Now let's look at bearish market structure. In a bearish market, a break of structure happens when price breaks below a previous major low. This shows sellers are still strong. It confirms bearish continuation. For example, price creates a low. Then price pulls back and creates a high. Then price drops and breaks below the previous low. That is a break of structure to the downside. After price creates that break of structure, the high that caused the break becomes the major high. The major high is the high where sellers stepped in. It is the high that pushed price below the previous low. It is the high that protected the bearish trend. So in bearish structure, the major high is extremely important. As long as price stays below that major high, the bearish structure is still protected. Now let's answer a very important question. What is a valid break of structure? A valid break of structure should break a clear structure level. It should show displacement, and it should close or accept beyond the level. Displacement means price moves through the level with strength. It does not slowly tap the level. It does not barely touch it. It does not create a tiny wick and instantly reject. A bullish break of structure should break above the previous high with clear bullish pressure. A bearish break of structure should break below the previous low with clear bearish pressure. For beginners, the safest rule is to wait for a candle close beyond the level. Why should we wait for a close? Because wicks can be traps. Price can wick above a high, trigger breakout buyers, collect buy-side liquidity, and then drop. That is not always a true break of structure. That can be a liquidity sweep. Price can also wick below a low, trigger sellers, collect sell-side liquidity, and then pump. That is also not always a true break of structure. So what is not a break of structure? A tiny wick above a high is not automatically a break of structure. A tiny wick below a low is not automatically a break of structure. A break of a random small internal level is not automatically a major break of structure. A weak move with no displacement is not a strong break of structure. And a level that instantly rejects can be a liquidity sweep, not a true structure break. So before calling something a break of structure, ask yourself, did price break a clear structure point? Did price break it with strength? Did price close or accept beyond the level? Or did price only wick and reject? If price only wicks and comes back, be careful. The market may not be breaking structure. It may be collecting liquidity. Now let's move to change of character. A change of character means price behavior may be changing. It tells us that control may be shifting. Buyers may be losing control, or sellers may be losing control. But this is where many traders make a big mistake. They think every small break is a change of character. Price breaks a tiny low, and they say, the market is bearish now. Price breaks a tiny high, and they say, the market is bullish now. But no, that may only be minor structure. And minor structure does not automatically change the full trend. There is a difference between a minor change of character and a valid major change of character. A minor change of character happens when price breaks internal structure. It can show short-term weakness. It can show a pullback. It can show a temporary momentum change. But it does not automatically mean the entire trend reversed. Now let's look at a bullish example. Price is in a bullish structure. Price creates a break of structure to the upside. We mark the major low. Then price starts pulling back. During that pullback, price breaks a small internal low. A beginner immediately says, "This is a bearish change of character." But wait, did price break the major low? No. Then the main bullish structure is still valid. That small break may only be a minor change of character. It may only be a pullback inside bullish order flow. So in a bullish market, a bearish change of character becomes valid only when price breaks below the major low. Not a small low, not a random low, not a tiny internal low. Why? Because the major low is the level protecting the bullish trend. If price breaks below the major low with displacement, buyers failed to protect the level that mattered. That is when sellers may be taking control. Now let's look at a bearish example. Price is in a bearish structure. Price creates a break of structure to the downside. We mark the major high. Then price starts pulling back. During that pullback, price breaks a small internal high. A beginner immediately says, "This is a bullish change of character." But again, wait, did price break the major high? No. Then the main bearish structure is still valid. That small break may only be a minor change of character. It may only be a pullback inside bearish order flow. So in a bearish market, a bullish change of character becomes valid only when price breaks above the major high. Not a small high, not a random high, not a tiny internal high. The major high. Why does the major high matter? Because the major high is the level protecting the bearish trend. If price breaks above the major high with displacement, sellers failed to protect the level that mattered. That is when buyers may be taking control. Now let's make this very simple. In bullish structure, the major low protects the trend. If price breaks the major low with strength, we can have a valid bearish change of character. In bearish structure, the major high protects the trend. If price breaks the major high with strength, we can have a valid bullish change of character. That is the clean rule. Now let's talk about invalid change of character. An invalid change of character happens when traders call a reversal too early. The first type of invalid change of character is when price breaks minor structure only. For example, price is bullish. The major low is still protected. Price breaks a small internal low. A trader sees the small break and sells. But price never broke the major low. So the bullish structure is still valid. That bearish change of character is invalid as a full reversal signal. Price can continue higher and trap sellers. Now in bearish structure, price breaks a small internal high. A trader sees the small break and buys. But price never broke the major high. So the bearish structure is still valid. That bullish change of character is invalid as a full reversal signal. Price can continue lower and trap buyers. The second type of invalid change of character is when price only wicks through the major level and rejects. For example, price is bullish. Price wicks below the major low. Sellers get excited. They think the trend has changed, but price closes back above the major low. That may not be a real change of character. That may be a liquidity sweep. The market took sell-side liquidity and continued higher. Now, in bearish structure, price wicks above the major high. Buyers get excited. They think the trend has changed, but price closes back below the major high. That may not be a real change of character. That may be a liquidity sweep. The market took buy-side liquidity and continued lower. So before calling a change of character valid, ask yourself 3 questions. First, did price break the major level? Second, did price break with displacement? Third, did price close or accept beyond the level? If the answer is no, be careful. It may be minor structure, it may be a sweep, it may be a trap. Now let's put everything together with a simple checklist. Step 1. Start from the higher time frame. Identify the market sentiment. Is price bullish? Is price bearish? Or is price ranging? Step 2. Identify the trend. Is price creating higher highs and higher lows? Or lower lows and lower highs? Step 3. Identify order flow. Are buyers breaking highs and protecting lows? Or are sellers breaking lows and protecting highs? Step 4. Mark the major level. In bullish structure, mark the major low that caused the break of structure to the upside. In bearish structure, mark the major high that caused the break of structure to the downside. Step 5. Separate minor structure from major structure. Do not treat every small internal break like a full reversal. Step 6. Validate the break. Look for displacement. Look for a close. Look for acceptance beyond the level. And be careful with wicks, because wicks can be liquidity sweeps. Now remember this. Market structure gives you the map. The higher time frame gives you the direction. Order flow tells you who is in control. Break of structure confirms continuation. Change of character warns you that control may be shifting. A valid change of character breaks the major level. An invalid change of character traps traders who react too early. Most traders only see candles, but candles alone are not enough. The candle is the move. The structure is the story. And liquidity is where the trap is waiting. If this video helped you understand market structure more clearly, do not forget to like the video, subscribe to Professor Liquidity, and turn on the bell so you do not miss the next lesson. This is Professor Liquidity. Stay sharp, trade with logic, and never let the market make you the liquidity.